Welcome to TheoTrade. This is Don Kaufman. It's February 20th, 2019, and you are watching the TheoTrade evening video. With just 4 minutes left in the trading session, the S&Ps right now are up 4. The Nasdaq is down 8. It's a rather mixed bag of goods on a day where the FOMC minutes came out. Well, you know, the Fed cometh. They discussed a little bit, of course, about why the 180 in the Fed policy. Nevertheless, let me give you a little bit of an explanation here regarding the Fed, a little bit of insight to the Fed, and more appropriately, some other going-ons in the broader market. What I want to start with this evening has to do with interest rates, because all that we heard throughout the course of 2018 is that what? Rates were going to do nothing but go up. However, if you take a look right here, that's the TNX, that's representative of the 10-year Treasury Index. Well, unfortunately, that has done nothing but effectively go down. Now, granted, this is only a 9-month chart, but hey, let's get crazy. Let's open it up for an entire year, and this definitely looks trend-worthy, if you will, to the downside. I mean, effectively, what the FOMC said specifically in those minutes that came out today is that they're likely to end the balance sheet reduction, or at least hold off on balance sheet reduction or any further reductions at the end of 2019. Again, what does that really translate to? Well, let's go right to it. Here is, well, it's the Fed's website. I mean, what better place to get the data from other than the Fed themselves? For those of you that are unfamiliar, have never really looked at this, this is actually the quantitative easing balance sheet. It's the balance sheet from the Fed. And here was the beginning of the financial crisis. What did the Fed balance sheet do? Ballooned, exploded. There was quantitative easing part 1, there was part 2, there was the twist program. After that, it just got all kinds of crazy. But the Fed balance sheet has stabilized since about 2014, and we've started to contract the balance sheet. And again, we're somewhere right now in the neighborhood. They're shooting for 3.8 trillion. Nevertheless, there was an expectation. That this balance sheet initially was going to be tapered all the way down to 2 trillion. Well, halt the presses, because one of the things that they kind of delineated in the meeting, in the FOMC minutes that happened to come out, and I'm just zooming in right now, is that effectively it looks like they're going to end this tapering. They're going to end this tapering, it looks like, at least a pause, all right, and maintain a considerably higher balance sheet, pretty much in the neighborhood that we're currently at. Again, they're talking, that 3.8 trillion neighborhood, which again stands in stark contrast to anything that we've heard prior to that. Well, where does that leave all of us? First of all, this is not exactly a positive thing for the yield curve. So now we've actually switched from the Fed's website. Here's another fun website. This is the U.S. Department of Treasury. Couldn't be any more exciting, right? A couple of government websites all packed into one conversation. Oh, tell me it ain't so. So if you take a look at this, this is a lot of data to look at, and it's a little, difficult if you've never really looked at this. But what it comes down to is, here's yesterday. Again, here's yesterday's data. What this data happens to be is, if you look at 1 year, okay, and what is this? This 2.54. Well, what is that? Well, that's the interest rate associated with the 1 year. Right? So this is just paper, and paper is what? Debt. So whether it's a 1 year, a 2 year, a 3 year, by the Fed ultimately doing a 180, what they've actually said is, it's okay, let's go ahead and invert the yield curve. At least that's much of the way I would interpret it. And you can see the 1 year has already eclipsed now, of course, the 5 year. And that's something that was also relative earlier this month. But again, I would consider this steeper. You've even got the 1 year, the 7 year. There's the closing bell. I guess the one positive side of some of this is that it doesn't look like anytime soon our mortgage rates are going to go up. But what you very well could get, again, is this 1 year, even eclipsing, if you will, not only the 5 year, but even the 10 year. Again, look how close they are. We're talking a couple of basis points right now, where the 1 year and the 5 year, okay, so short-term rates are very likely to eclipse some of the longer-term rates, that we called an inversion of the yield curve, which, again, categorically speaking, in the past has actually been indicative, if you will, of a recession. Now, with all of that going on, and I'll come back to this site in just a second, with all that going on, the S&Ps continue to kind of chug to the upside. I mean, the market's kind of laughing at this and saying, what? me worry. And here we have the S&Ps again off the bottom, which is well, quite lovely from about the 235 level, almost just shy now of the 280 level. You know, as I was saying a little bit earlier today on TheoTrade, you know, people are looking at this and all they're talking about right now happens to be the collapse in volatility. Nevertheless, we almost have to redefine a little bit of what we term volatility, because if we actually look at the sell-off versus the bid back to the upside, they happened actually in relatively short order. You could actually categorize, again, some of the move that we've seen to the upside is and as volatility, if you will, to the upside, which is interesting from the perspective of this. Okay, one thing I've been, yelping about and barking about nonstop in the last couple of weeks, you don't want to be an option premium seller in this. I'm going to reiterate that again. And it's one of the bigger takeaways from all of this. We're talking about, interest rates not necessarily going up anytime soon. Now the Fed is saying, let's not contract the balance sheet. Let's not get crazy. Actually, one of the other things they were talking about at the Fed meeting was the effects on the stock market considerably. It was actually one of the longer discussions they had. But one of the things that really is striking in this entire move isn't necessarily the speed of the sell-off. It's the speed at which we've actually come back. And again, as everybody's talking about the collapse of volatility, what I'm actually discussing day in and day out is, hey, wait a second. If the market's capable of moving this fast, it still is volatility. It's just historical volatility. But you don't want to be an option premium seller because you're not getting paid to take that risk. Okay. Again, historically speaking, as markets go up, implied volatility, that is option volatility, goes down. Okay. Why would you want to sell options? And people, of course, they're going to turn around and say, well, I would rather sell puts. I would sell puts all over here. Yes, but then you have to be right. And you have to assume that we're not going to collapse back down at any point in time. Nevertheless, the place to be is an option buyer. Again, an option premium buyer in the last couple of weeks and for the foreseeable future, even if that means that you're buying, if you will, out of the money puts, things like risk twist spreads. I'm not a big advocate of just going out there and say, let's buy an out of the money call. I don't buy out of the money options. I don't buy purely extrinsic or time value. I'm using a number of strategies, a little bit more depth to that. But when I talk about buying premium, something like a risk twist spread, which would have a target if the marketplace was to come back down. I mean, think about it. Buying out of the money puts using types of ratios, they're dirt cheap. They're dirt cheap. Not only is the volatility down in the S&Ps, okay, however, that's critically important, but not only is the volatility down, but the skew is inherently low as well. And some people don't look necessarily at skew, and I don't want to completely geek out at you, but the skew is also low. So the question is, where might some of the biggest, if you will, kind of, trades play out? One of the trades that I'm looking at extensively for this, we're gonna cruise over to, we're going to the charts. Okay. One of the trades I'm looking at extensively, I'm going to cruise down to load style, and I'm going to come in here and I'm going to give you a comparison chart. This is a comparison chart between the Qs, which is the Nasdaq, the IWM, which is the Russell 2000, and of course the spiders. And what I wanted to show you is, if you're looking for like, okay, what might be the biggest bang for my buck? Well, take a look at the top of your screen right up there. That's the IWM. That thing is up almost 17%. Again, almost 17% on a year-to-date basis. Now, granted, the IWM, okay, just a few months ago, and we're going to back up for a second, just a few months ago, the IWM was absolutely getting decimated. It has come back stronger. And that, okay, only out of a comparison is where we believe, and again, I'm going to cruise over to the IWM, where we believe that there might be, okay, the biggest trade, if you will, and taking shots inside of the marketplace. The IWM, until very recently, had much higher implied volatility. The implied volatility has now effectively come down also inside of the IWM, providing, again, ample trades. What kind of trades would I look for in here? Well, as I said, these are trades, things like risk twist spreads. And for those of you unfamiliar with the risk twist spread, it's a type of like ratio back spread. I come over here and sell maybe some 154s. And again, kind of building this, off the cuff a little bit. So I'm selling some 154s, maybe buying 1, 2, 3 of these, selling one of those. Okay. It's a 54. Okay. So I'm selling one of the 154s, buying 3 of the 148s, and selling 1 of the 146s. Again, the implied volatility, right, has made this a much more, eloquent trade at this point in time, which was that was in contrast again to what we saw even last week. The implied volatility was still relatively high in the IWM. It's come off enough where these trades have become rather effective. In fact, you could even justify going further out in time. Something, again, I'll play around with a little bit more in the TheoTrade chat room as of tomorrow. The other thing that's really kind of on my mind, so the IWM is just a big time outperformer. Again, I just want to bring it up on a year-to-date basis because it's up effectively 17%. The other outperformer, right with it, is what's driving a lot of the S&Ps. And this one actually begs a mention over here because I've been talking about the XLF ad nauseum. The XLF now up about 11% on a year-to-date basis. But let's not talk about percentages. Let's talk about the fact, that the XLF has now hit its marquee level and is above that marquee level. It's 2650. I've talked about this again ad nauseum, but it is the financials. They're driving the S&Ps right now. If you take a look, in just the last couple of trading sessions, the financials have actually spurted to the upside. And when I say that the financials are driving the order flow, go take a look at the Nasdaq at the exact same time frame. What do you got out of the Nasdaq? Not much. I mean, literally, the last 3 trading sessions in the Nasdaq have been massively unchanged, with the financials continuing to kind of forge forward. And this is the part I think a lot of people are going to like. Those financials continue to forge forward. You're going to have the S&Ps. And I'll zoom into this one for you. You're going to have the S&Ps take that shot right here at 2811, our next gravity point to the upside. Now, if I zoom back out, again, we're going through a lot of different levels, kind of rapid fire over here. That would actually take us right to the top, of this volatility box. And we'd be right back into it. Again, we need to keep eyes on the financials. They're driving the bus right now of the S&Ps. We're already looking at weakness inside of the Nasdaq. We're talking about one of the most effective shorts, which would probably be the Russell in kind of the near term. But we have to be mindful, again, of what those financials happen to do. Again, the big overwhelming theme that I want you to pick up on here is we're not going to be selling options premium, anytime in the near future. Why? Because implied volatility isn't just crushed down. It's not the fact that the VIX is low. It's not the fact that implied volatility, has once again, gotten whacked down inside of the SPX. It's all about the fact, that the historical volatility, that is the actual price movement in a product like the SPX, in a product like the IWM, in a product like the Nasdaq, in individual stocks, actual price movement in almost all the cases we just brought up are exceeding what the implied volatility is paying us. With that, again, I want to thank everybody for coming here to TheoTrade, joining us on the nightly video. I'll be back in the TheoTrade chat room first thing in the morning. Have a wonderful evening, everybody. Bye-bye.